Welcome, the learner, to another deep dive, something we put together just for your curious mind. Think of the All Sorts podcast as this thriving garden of knowledge. Every time you join us, something new is blooming, unique ideas, fresh perspectives.
It's a nice way to put it.
And we really hope you'll help us tend this garden. Liking, sharing, subscribing on the All Sorts podcast YouTube channel that's like the sunshine and water, honestly. It helps us bring you even richer stuff.
Absolutely. Every bit helps.
And hey, don't forget, our archives are packed with other interesting deep dives, just waiting for you. Check us out on X, Instagram, and Threads too. Keep the exploration going.
There's always more to learn.
So true. Today, we're zoning in on understanding economic growth. We're talking rates, the factors behind it all, and even looking at some forecasts for the future.
Yeah, we've pulled together quite a bit of information definitions, how it's calculated, what drives it, and like you said, a peek at what some analysts are predicting.
Yeah. Our goal here is really to break down this, pretty complex subject. Get to the core insights so you can grasp the essentials without feeling totally bogged down.
Exactly. Let's try and make sense of it.
Okay, let's dive in, starting right at the beginning. What exactly is the economic growth rate?
Fundamentally, the learner, it's the percentage change in the total value of everything a country produces, all the goods, all the services over a specific time compared to, an earlier time.
Like a health check for the economy.
Precisely. It tells you how things are changing over time, usually reported quarterly and then annually. And for the U.S., and most places really, the headline number you hear is the change in gross domestic product, GDP.
Right. GDP. Everyone talks about GDP.
Yeah, and the basic idea is if people and businesses are demanding more stuff, companies tend to produce more to meet that demand, and that leads to a higher growth rate. Simple supply and demand, in a way.
Okay, so GDP is the main scorecard. But you mentioned there are other ways to keep score.
That's right. GDP measures everything produced inside a country's borders. That's the most common one. But then there's GNP, gross national product.
What's the difference there?
GNP looks at the total output produced by a country's residents and businesses. It doesn't matter if it's made here or overseas. So it includes income earned from investments abroad, for instance.
Okay. A slightly wider lens.
Exactly. And then there's NDP, net domestic product. This one takes GDP and subtracts depreciation.
Depreciation, like wear and tear.
Exactly. Wear and tear on machines, buildings, infrastructure. So NDP gives you maybe a more sustainable picture of growth because it accounts for the capital getting used up.
Interesting. And then there's this real versus nominal thing.
Oh, that's crucial. Absolutely crucial. Nominal growth uses current prices. So if prices go up, inflation, nominal GDP goes up, even if we aren't actually producing more stuff.
So it can look like growth, but it's just inflation.
Precisely. Real growth adjusts for that inflation. It strips out the price changes to give you a much clearer picture of whether the actual volume of goods and services increased. That's the number you really want for comparing over time.
Got it. So how do they actually calculate that percentage rate we see?
The basic formula is pretty simple. You take the GDP from the later period, subtract the GDP from the earlier period, and then divide that difference by the GDP from the earlier period.
Okay. GDP later, GDP earlier, GDP earlier.
Exactly. Times 100 to get the percentage. And it can be positive, showing growth, or negative, showing the economy shrank. Like Q2 2023 in the U.S., the rate was 2.1%. Up a tiny bit from 2.0% in Q1.
Now, what about this annualized rate I keep hearing about for quarterly numbers? Is it just like multiplying the quarters growth by 4?
Good question. It's related to that idea, but a bit more complex. The Bureau of Economic Analysis, the BEA, they report quarterly GDP, and yeah, they often annualize it.
So what does that really mean?
It's basically saying, okay, if the economy kept growing at this exact same quarterly pace for a full year, this is what the annual growth rate would be.
So it's a projection based on that one quarter.
Exactly. The actual formula is you take 1 plus the quarterly growth rate, raise it to the power of 4, and then subtract 1. So say a 0.5% quarterly growth. That annualizes to about 2.016%.
So it compounds, essentially.
Right. But the key thing is it's an extrapolation. One good or bad quarter doesn't guarantee the whole year will follow suit.
That makes sense. It could be misleading then.
It definitely can be if you don't understand what it represents. Remember, Q2 2020, early pandemic, the annualized rate was a shocking minus 32.9%.
Whoa! Yeah, I remember that figure.
But the actual decline in that quarter compared to the previous one was minus 9.5%. Still terrible, obviously, but the annualized number really magnified it.
So it's important to look beyond just that headline annualized figure.
Absolutely. Sometimes looking at year-on-year rates comparing, say, Q2 2020 directly with Q2 2019 gives a clearer picture of the actual change over a 12-month period.
Okay. And going back to the real growth rate that adjusted for inflation one, how does that fit in? It sounds like the most important one for comparisons.
It really is, especially over longer periods or between countries. You calculate real GDP first, that's the nominal GDP divided by basically a measure of inflation since some base year.
Right, taking out the price effect.
Exactly. Then the real GDP growth rate is just the percentage change in that real GDP figure from one year to the next. Same formula as before, just using the inflation-adjusted numbers.
And that lets you compare apples to apples, even if inflation is wildly different.
Precisely. It gives you the change in actual economic output. For context, U.S. real GDP end of Q3 2024 was around $23.4 trillion, and the annualized real GDP growth in that quarter was 3.1%.
Okay, I think I've got a better handle on the what and how of measuring growth. Let's shift gears. What actually causes an economy to grow? What are the main drivers?
Yeah, great question. There are several big ones. First up is investment. Big time.
Investment in what, like stocks and bonds?
Well, not exactly in this context. We mean investment in physical capital. Think new factories, machinery, roads, communication networks, that kind of stuff. Things that help us produce more.
Okay, tangible assets.
Right. And also, crucially, investment in human capital.
Human capital, meaning people.
Yeah, essentially.
Okay.
It's the skills, the knowledge, the health of the workforce. So education, job training, even healthcare access, these things make workers more productive, more innovative.
So investing in stuff and investing in people.
Exactly. And generally, higher levels of both tend to lead to higher growth rates. Some research even suggests, that investment in R&D, research and development, can have a particularly big payoff for future growth compared to just buying more of the same machines.
Right, because that leads to new ways of doing things. Which brings us to technology.
Precisely. Technology is the second huge driver. Innovation, developing new technologies, and finding better ways to use existing ones is probably the most powerful engine for long-term growth.
How so?
Well, it leads to more efficient production, entirely new products and services nobody even imagined before, and just generally boosts productivity across the board. Think about the internet, automation, breakthroughs in medicine. Massive impacts.
Yeah, it's hard to overstate the impact of technology.
For sure. Although, interestingly, sometimes when a really disruptive technology comes along, like the early internet, you might see a temporary dip in measured productivity as businesses figure out how to actually use it effectively.
Huh. That's counterintuitive.
A little, yeah. But it often takes time to reorganize work and fully integrate the new tools. Then, once it clicks, you often see a big surge in productivity later on.
Okay, so investment and technology. What else?
The labor force itself, its size and its quality. A growing workforce, especially one with the right skills, obviously increases the economy's capacity to produce.
More hands on deck, basically.
Kind of, yeah. But it's not just numbers. Again, education and training are vital to make sure those hands have the skills needed for modern jobs to adapt to new technologies.
So people, skills, technology, investment. What about the government? Does policy play a role?
Absolutely. Economic policy is critical for setting the stage for growth.
Yeah.
We're talking about fiscal policy, government spending, taxes,
Right.
and monetary policy. That's the central bank managing interest rates, aiming for stable inflation. Good, stable policies in these areas create predictability.
And businesses like predictability.
They love it. Predictability builds confidence. Businesses are more likely to make long-term investments if they feel the rules of the game aren't going to change dramatically overnight. Efficient regulation, not overly burdensome, also helps.
Okay, those sound like the big long-term building blocks. Are there things that push growth up or down more in the short term, like affecting demand?
Yes, definitely. In the short run, we often focus on aggregate demand, or AD. That's the total demand for everything in the economy.
And what makes that go up or down?
It's calculated as consumption, household spending, plus investment, business spending, plus government spending, plus net exports, exports minus imports. So anything affecting those components matters.
Like what specifically?
Things like interest rates, lower rates can encourage borrowing and spending. Consumer confidence, if people feel good about the future, they spend more. Asset prices, rising house prices or stock markets can make people feel wealthier and spend more. Real wages, if wages are rising faster than inflation, people have more purchasing power. Exchange rates affect export competitiveness. Even the health of the banking system, are banks willing to lend?
So lots of moving parts on the demand side.
For sure. And sometimes one factor can dominate. Like after the 2008 crisis, interest rates were super low for years, from like 2009 to 2016. But growth was pretty sluggish.
Why didn't the low rates work then?
Largely because confidence was shattered both for consumers and businesses. And banks were more cautious about lending, so just lowering rates isn't always a magic bullet if other demand factors are weak. Or think about falling real wages that can really force households to cut back.
Okay. And what about the supply side in the short term? Is that different from the long-term factors?
The long-term supply factors, infrastructure, skills, technology, they determine the economy's overall potential, the long-run aggregate supply, LRAS. But yes, short-term shocks can affect the ability to supply goods right now.
Like what kind of shocks?
Think about a sudden spike in oil prices. That increases costs for almost everyone, potentially reducing output in the short term. Or major disruptions to infrastructure, like from a natural disaster. Even short-term labor shortages in key areas. Productivity itself can fluctuate in the short term, too.
So short-term supply hiccups are possible. Are there any other quick-acting factors?
Yeah, a few others. Commodity prices, like we mentioned oil, can have pretty immediate effects. Political instability is a big one. Uncertainty makes everyone hesitate. And sometimes just plain old bad weather can disrupt things temporarily.
It's a complex picture. You mentioned the UK earlier. Could you give those examples again of how these factors played out there?
Sure. So the UK recession back in '81 saw negative growth. Key factors then were high interest rates used to fight inflation, cuts in government spending, and a strong currency making exports expensive.
Tough mix.
Definitely. Contrast that with the mid-'80s boom. That was driven by rising consumer confidence, lower real interest rates, house prices and wages going up, which fueled spending, plus some supply-side reforms like privatization that were intended to boost efficiency.
Okay. Different conditions, different outcome.
Exactly. Then jump to 2009 negative growth again. That was a perfect storm. High oil prices hitting costs, the global credit crunch freezing up lending and investment, and falling house prices hurting confidence and wealth.
Right, the financial crisis fallout.
Precisely. And finally, that long period of pretty stable growth from about 1992 to 2007, sometimes called the Great Moderation, that was helped by tech advances, especially IT and the internet, plus relatively stable inflation, partly thanks to independent central bank policy.
Those examples really bring it to life.
Yeah.
Okay, let's turn to the future now. What are the forecasts saying? You mentioned a global quarterly economic forecast from March 2025. What's the vibe there?
Yeah, the vibe is cautious. Generally, the outlook for global growth was downgraded in that forecast. A lot of it seems tied to expected policy shifts, particularly mentioning potential changes in the U.S.
Policy shifts causing downgrades.
That seems to be the main theme, yeah. The forecast highlights a risk of lower economic growth overall, combined with stickier, higher inflation.
Lower growth, higher inflation. Stagflationary pressure.
That's certainly the concern flagged. Specifically for the U.S., the forecast mentions a risk of stagnation due to, well, potentially significant and lasting tariffs on trade. The source also mentions DOGE efforts undermining labor, though it's not entirely clear what that refers to specifically in the source document.
Okay, so tariffs are a big concern mentioned in that forecast.
A very big concern. They see it potentially hurting the labor market and overall activity, even assuming some offsetting tax cuts. Canada is also singled out as being quite vulnerable to U.S. tariffs, with the expectation that the Bank of Canada might need to cut rates more aggressively to cushion the blow.
What kind of tariff levels are they assuming in this forecast?
The assumptions laid out are pretty specific. They pencil in widespread U.S. tariffs starting early April 2025, hitting an average effective rate of 14% for 6 months.
14%? That's high.
It is. Then they assume negotiations bring that down gradually to about 7.5% by the end of 2025. They also expect trading partners to retaliate with their own tariffs on U.S. goods, though maybe not matching dollar for dollar.
So a trade conflict scenario.
Essentially, yes. The forecast does assume a new USMCA trade deal gets done later, maybe late 2026, bringing the average U.S. tariff rate down to around 5.3% eventually. For Canada specifically, they model tariffs on their exports to the U.S. hitting 12.5% for that first 6 months, then easing to 5%.
Are there other big policy assumptions driving this particular forecast?
Yes, a few others mentioned. On fiscal policy, partial tax cuts in the U.S. are assumed, worth about 0.5% of GDP. In Canada, they assume increased government spending, about 1% of GDP, to try and counter the tariff impact.
Okay.
And interestingly, they project a big slowdown in immigration for both countries. U.S. net immigration falling to 750,000 in 2025, then 500,000 in 2026. Canada's population growth is also expected to slow down significantly.
Wow. Okay. So based on all that, tariffs, fiscal moves, immigration changes, what's the bottom line for the U.S. and Canadian economies in 2025, according to this specific forecast?
For the U.S., the outlook for 2025 is weaker. Downgraded due to that policy uncertainty, the direct hit from tariffs, and some government spending restraint assumed. Unemployment is forecast to tick up slightly.
And inflation.
Expected to rise. Core PCE inflation, that's the Fed's preferred measure, is projected to peak around 4.3% annualized in Q2 2025. And because of that, they think the Fed will be limited in cutting rates, maybe only managing 2 cuts all year.
And Canada.
The forecast suggests Canada might slip into a shallow recession sometime in 2025, primarily because of those U.S. tariffs hitting their trade, but also affecting housing, business investment, consumer spending, leading to net job losses expected there.
That sounds pretty significant. What about the rest of the world?
Generally downgraded growth across the board, again, largely due to the ripple effects of those potential U.S. tariffs impacting major trading partners. Within Europe, Germany is expected to boost spending on infrastructure and defense. China has set a growth target of around 5% for 2025, planning more government stimulus, but they're also facing headwinds from the tariff situation and their own internal structural issues.
Okay, that's one detailed and somewhat concerning forecast. What about more immediate signals? You mentioned the U.S. leading economic index. What's that telling us right now?
Yeah, the Conference Board's LEI. It's designed to signal turning points in the economy. In February 2025, it actually fell slightly by 0.3% down to 101.1, so continuing a recent downward trend.
Still pointing down then.
Still pointing down, yes. Although looking at the 6-month change ending in February, the drop was 1.0%. That's actually less steep than the decline in the previous 6 months, so maybe the headwinds are easing up a little.
A glimmer of hope, perhaps? Or just falling less fast?
Maybe the latter. The report did highlight that consumers' expectations about future business conditions worsened in February. That was the biggest negative drag. And manufacturing new orders also pulled back.
So mixed signals from the LEI.
Kind of. The overall index is down, signaling caution. The rate of decline has slowed, which is maybe slightly positive, but key components like consumer expectations are weakening. The Conference Board's own take, based on this, is that U.S. real GDP growth is likely to slow to around 2.0% in 2025. They cite that policy uncertainty and the softer consumer picture.
It really does feel like a period of, well, flux and uncertainty economically.
I think that's fair to say. While the coincident index, the one measuring current conditions, actually edged up in February, the leading indicators and that global forecast we discussed paint a picture of likely moderation ahead. Those potential trade policy impacts remain a really significant question mark.
So, the learner, wrapping up this deep dive, we've really covered a lot of ground on economic growth. We looked at how we measure a GDP, real versus nominal, those tricky annualized rates.
And then we explored the key drivers investment, both physical and human, the huge role of technology and innovation, the labor force, and how economic policy sets the stage.
Right. Plus those short-term factors, demand and supply shocks, that can cause bumps along the way. And finally, we peeked at some current forecasts, which, well, suggest some potential challenges ahead, particularly around trade policy.
Yeah, understanding all these pieces, the rates, the factors, the forecasts, it really gives you a better lens for making sense of the economic news you hear every day. Hopefully it helps you make more informed decisions, too.
We really hope this exploration has shed some light on it all for you. As you think about everything we discussed, investment, tech, policy, those demand factors, and now these forecasts mentioning potential tariffs. What strikes you as the most critical element shaping our economic future right now?
It's a great question to ponder.
Definitely. And remember, the learner, this conversation is just a starting point. We really encourage you to dig deeper into some of the sources and ideas we touched on. Keep that learning journey going.
Absolutely. There's always more to understand about how the economy works.